If you're buying a home but you don't know how much to put down, then this is the right video for you. My name's Davin Sunvik and welcome to the House Hacker Tribe. So in this video, we're going to be talking about how to pick your down payment. Now, if you're a real estate investor, you might want to get zero money down because you really value your capital and you want it to be working in other deals. But not every single real estate deal is the same, and so we might need to go over some of the finer details to help somebody understand which category they might be in when picking a down payment. Now, I want to go into the first category of people that are buying a home. These people are renters and they don't have a lot of money on hand in order to buy a home, but they really have seen the value in owning versus renting, and they understand that owning is going to be a better long-term plan for them. So they are either in a position where they could wait and get a bigger down payment or buy with their current down payment options. So what would I typically recommend for this person? Let's just say they have 3% or 2% to put down. So not even enough to cover an FHA loan of 3.5%. Well, for this particular type of person, it's definitely better to own if they can. You don't know if you'll ever qualify in the future. You can only know if you qualify today. And there are some down payment assistance programs that are available to you. In Nevada, we've got some, for example, and we call them first-time homebuyer programs or down payment assistance programs. Or if you're a veteran, you've got some access to VA loan programs, and same with teachers. So the next type of person I want to talk about is the person who has maybe about 5% to put down, right? Maybe they're shopping for a $300,000 house and they've got $15,000 plus some extra money to cover the closing costs. And they're deciding, well, should I put down $15,000 or should I put down maybe like $11,500 and put down 3.5%? It's a great question here. And something that I would ask this person is, are you comfortable living without that little extra amount of money and knowing that the PMI, the private mortgage insurance, can be removed later on? Well, to sacrifice 1.5% of a down payment, which could be worth, in this particular case, maybe about $4,500, right? You could be removing maybe about $150 a month off of your mortgage payment later on down the line after your home has gained some equity, maybe after it's appreciated in value, and after you've paid down the loan a little bit. So that's one option. If this person says, you know what, I really don't need the extra month-to-month income, I really would like to have that money sitting in my bank account because I want to buy some furniture, I want to, maybe do some repairs on the property, or maybe I want to upgrade the kitchen, and I want to have that cash on hand. Well, if you're not afraid to refinance later, then maybe going with an FHA loan is going to be right for you. However, you do have to remember that on the FHA loan programs, you're not going to be able to remove the PMI until you refinance the loan, and you don't know what loan rates are going to be in the future. So if you're currently working with a high interest rate, it's probably not going to be a big deal for you to refinance in the future. But if you're working in a market that has a low interest rate, like at the time we're filming this video, it might be a little bit better to think about that conventional loan. All right, so let's jump forward and go into some of our high income earners, people that maybe have owned a home before. Maybe they sold one and they moved and they're going into a new home, and that's why they have a big lump sum of cash. Or maybe you received an inheritance or a big bonus at work, or you've just been diligently saving for quite a while. And you might be thinking, based on the previous advice, oh man, if I've been saving for all this time, did I lose out? Not necessarily. So luckily, if you have a big down payment of maybe 20% or more, you have a ton of options. Let's just get into the example. If someone has 50% of the value to put down, they've got $150,000 to put into the property. Well, they can finance really cheap interest rates at the time of this video. So maybe call it 3.5%. And the market right now, and the stock market's returning at around 20%. Now, most of the time it's maybe around 8 to 10, but this particular last couple of years, it's been really moving. And so maybe you want to move it into the stock market to keep the growth going, right? So what I would do is I actually wouldn't put all $150,000 into the home. Even though you'd save a lot of money on the month-to-month payments, the amount of money that you're saving, you could have easily made way more elsewhere in the stock market. So I would finance all the way at least up to 80%. And then beyond that, I would look and say, well, if I'm going to get PMI on a conventional mortgage, right, then what is the difference in price for that extra cost of capital. How much is my mortgage bill going up based on that additional money? And kind of determine for yourself if your money could have been working somewhere else a lot faster, or if this money is best left in your home and, maybe getting some of those guaranteed returns. So that's what I've got to say about down payments and how to pick the right down payment for you. It's always going to be a complicated process, but I hope this video helps you. So if you haven't watched our video on PMI, go ahead and watch that one to understand that different parts of your loan are going to cost different amounts. Anything over an 80% loan, for example, if you can finance a $100,000 house at $80,000, that's 80%. But if you want any money above that, there's going to be an additional cost above just your basic interest rate. And we call that a marginal cost of capital. And early in the video, we talked about people who don't have as much money. They don't really care about marginal cost of capital because they're worried about the average cost of capital. People with a lot of money need to look at the details, and they need to be looking at things like marginal cost of capital. So go ahead and watch that video and make sure you stay tuned because we will be talking about how to calculate your marginal cost of capital. Thank you and have a great day.